Good afternoon, everyone. It's an honor to be here today. I've been surrounded by the Sohn community for as long as I can remember, and over the years, I've seen how impactful the organization is. But last year, it became much more personal to me when cancer touched one of my closest friends. I'm grateful to say, though, that she's on the path to recovery, and experiences like that remind us all why the Sohn Foundation matters so much. It's now my privilege to introduce someone who's a long-standing member of the Sohn family, someone who returns to London's stage year after year. Our speaker today is the founder and CEO of Muddy Waters Capital, an investment firm known for deep fundamental research across global companies. Muddy Waters also applies its understanding of macro market structures to long-oriented quantitative strategies. Please join me today in welcoming someone we're very excited to have with us, Carson Block.
Thank you. So thank you very much. This conference does mean a lot to me. It's an amazing cause, and so I'm happy to do my part to help raise money for it. Means a lot to me personally as well, because it was here 11 years ago that I actually connected with our anchor investor who enabled us to launch our first fund. So I think it's apropos to come clean about something very personal here. Look, times are different than they used to be. A lot's happened culturally and what in my life, and so something that my family's here, they're aware of, that as painful as it is for them to understand, I need to tell everybody, and that is, I like to go long stocks. So here's our disclaimer. It's a little different from last year. Just took out all the short stuff and just inverted it, but yes, we have a position. All right. So the area that we are really excited about and we've been involved in on the long side for a few years is mining, metals mining, in particular junior mining. Why is junior mining so attractive? Well, when I survey the markets, I don't see a lot of areas where it is like it used to be a few decades ago, where fundamental research does provide real edge. But in junior mining, there is a tremendous amount of edge. Okay, first of all, you can get venture-type returns in junior mining, but you have a lot more data upon which to base your decisions, number one. Number two, our macro thesis has nothing to do with metals prices. We got interested in this because we realized that there's been a huge underallocation of talent to the space over the years. So that's both on the operating side and also on the capital allocation side. When you look at the number of graduates with degrees in mining-related majors, they're way down since, at least in the US, since the late 90s. And that's across the board in other countries that also keep track of this data. And we also feel that a lot of the investors, sometimes air quotes around investors here, in the junior mining space don't really know what they're doing. So again, lots of opportunity for edge here. Now we got involved in mining because we connected with a very talented individual some years ago in 2017. His name is Darren McLean, and he was at a fund in Toronto. And so we've worked with him on a few projects over the years, and then he came in-house to work with us, and he's been with us for the past year and a half or so. All right. Now, with junior mining, the reason that you really should pay attention to this is because majors don't do greenfield exploration anymore. Going into the financial crisis, and they were walloped. So coming out of the GFC, it's been about balance sheet repair. They used cash flow to pay down their debt. Then their investors got addicted to cash flow. Their investors want dividends. And so their exploration budgets are principally focused on brownfield exploration. So that's where they have existing deposits. They're looking to find adjacent deposits, where they already have infrastructure, and to optimize what they have. So in order for them to grow, they need to acquire juniors that have good greenfield discoveries. Now, there is a macro trend here at work, which is we need to pull more stuff out of the ground, regardless of the mineral. Yet, when we're talking about gold, the number of discoveries, the number of new discoveries has just massively shrunk over the years. So you could see that in the 1990s, the average discovery was about 9.2 million ounces of gold. You know, in this decade, we're at about 4.5 million ounces. But the bigger problem is that there are far fewer discoveries. So for this decade, we're on pace to do about 60 million ounces of discoveries versus 1.7 billion ounces discovered in the 1990s. So what does that mean? Well, the majors are effectively devouring themselves because, you know, the deposits they have, they are mining, and they need to replace these deposits. There's no terminal value to these majors because they're producing. So that's why we are long a company called Snowline Gold Corp. Snowline is listed in Toronto on the venture. It has conditional approval to uplist to the main board. There's also a US line. And this is, we think, really probably the only asset out there right now that can actually move the needle for a mid or a major. All right. It's got 2.1 billion market cap right now. That's Canadian. Their land package is in the Yukon. They have total land of that's about the size of Luxembourg. So it's purely greenfield. Their first discovery hole was drilled in January of 22. Now, the one project that is the most advanced and the one that will drive the value of this business in a sale is called Rogue, specifically Rogue's Valley deposit. And that has about 8 million ounces of gold that measured and indicated above 1.21 grams per ton. So in an acquisition, and this is why you want to buy Snowline. So again, remember, right now the market cap is 2.1 billion CAD. We think this goes, if this sells in the next year, we think this goes between 4 and 6 billion CAD. We don't think this is going to be out there for more than 3 years. And the longer it takes to acquire it, the higher that value will be. And I don't say that based on the assumption that we get to $5,000 or $6,000 an ounce gold. That's just based on where the majors are and how much they'll advance this project between then and now. So these properties, these discoveries are located in the Yukon. Now, the Yukon is a very well-known gold mining district. There was a big gold rush there, and about 20 million ounces were mined over the years. But that was all placer mining. So that's basically riverbeds and stream beds, getting the gold that's come out of the sand and separating it. Now that's important because the Yukon has never had what's called a major hard rock discovery. Okay, so everything that ends up being mined in placer mining, it started as hard rock, and then through rivers that have run through over the millennia, that's eroded. So that's what makes this one so interesting. It's because the founders of this company, it's a father and son, Ron Berdahl has spent 3 decades with this theory, trying to prove this geological theory that the Yukon has major hard rock gold deposits. And just going back to that point that I was making about why majors don't like to do greenfield, to find a discovery like this guy, year after year, months out of the year, he gets on a bush plane, he gets dropped off in some remote part of the Yukon, he lives by himself for months, to pickaxe, getting soil samples, putting them in bags. Eventually he gets picked up by the plane. You know, maybe it shows up the day that they agreed, or maybe there's a weather problem. Get back, send it to a lab, learn, and do it again. Greenfield is very hard. All right, but what we have here with Snowline's Rogue project, the Valley deposit, this is what we are calling a true Tier 1 freak discovery. So if you look at this, see that kind of pinkish or lavender color? That's the highest grade ore right there, meaning it's got the highest concentrations of gold in the deposit. And then you get this concentric decrease out from there. Now that is really important to the economics. You can see that this is basically on the surface. So eyeballing it, probably over the millennia, 20 to 30% of the deposit was eroded away by the water that used to go through that area. But that means that there's serious mineralization right there. This looks a lot like an open pit, basically, an open pit waiting to happen. Now, I'm sure people are thinking, oh, Carson, how do you know they're not bullshitting you? And in mining, I mean, look, we run long and we run short. So, there are definitely people in the junior mining space you want to short. And the way you mess around as a junior miner, you don't actually have to lie. You basically, it's kind of like level 3 fair valuation of assets. You build these models based on your drill intercepts, based on what you pull out of the ground, and you extrapolate. But here, so what you want to avoid is you want to avoid these nuggety deposits where, there's like a big, there's a very high concentration of gold or whatever mineral, and then, not so much, and then maybe another big one. Because that's where the geologists get in trouble. Well, nobody gets in trouble anymore, but that's where they can smear the sample. This does not have that problem. You do not have this nuggety gold. This is consistent all the way through the deposit. And just to illustrate that point, if you take out all of the outliers, the concentrations that are above 10 grams per ton, that only affects the overall grade by 5%. So that speaks to the idea that we can have a high level of confidence that this is not a smeared model here. All right, so when you get this sort of mineralization near the surface and you get these concentric, it decreases a little bit as you concentrically, again, that looks like an open pit. So the strip ratio, meaning the amount of waste rock for ore mined, is really low. Life of mine here, right now, it's one to one in terms of tons. But for phase 1, and this is a critical point to understand about mining, you want to be able to cash flow the mines as soon as possible. So this idea that, hey, if we pull all this mineral out of the ground over the life of the mine, you want to be able to do that upfront with as little cost as possible, because that's how you get a high NPV. So that's what's beautiful about this. And when you think about phase 1, they're projecting a strip ratio that's like almost absurdly low, of 0.14 to 1, because 39% of the gold is expected to be in the first 15% of material they pull out of the ground. All right, that's reflected here. These are Snowline numbers. But when you look at the projected annual gold production in terms of thousands of ounces, okay, you see that this is very front-end loaded. And so the costs are quite low for that phase 1. Now, this is not optimized. They have not done optimized engineering here. We believe that they could shorten the life of mine here to 15 years, and that when you see it averaging about 300,000 tons per year, they can probably pull that up to about 400,000 tons. So that'll also boost the NPV of this. But even with that non-optimized engineering, the NPV on this is 10.0 billion CAD right now. Again, that is just Rogue's Valley deposit. They have land that's equivalent to the size of Luxembourg. So there's a lot of optionality there that's embedded with this company if you're a major and you're looking at this. I mean, we have not seen economics like this, where you're talking 10 billion CAD NPV on a project. Now, from this comp, there aren't any really good comps out there. What you can see from this comp table is that when these companies are acquired, they're generally acquired above 1 times NAV. Right now, this company is selling at about 0.2 times NAV. So with Osisko, that was acquired in 2 tranches. So the first tranche was below NAV, then the second tranche was well above NAV. Now, even if gold prices fell to 2,100 US an ounce, this is still a 3.2 billion CAD NPV project. Again, contrast that with the current market cap / EV of 2.1 billion. The downside here we think is very low. And even at that 3.2 billion, that's still a lot bigger than any of these semi-comps. So the question is, this begs the question, why, oh why, does this opportunity exist? All right, one thing that's not on the slide, but it's kind of a soft point here. I told you about the Birdalls. They're actually they're very serious about operating the business. They're not promotional people. They're the kind of people you'd want to invest in. And again, this has been on the Toronto Venture Exchange. They're only now putting it on the main board. So they have not been out there pounding the table and jumping up and down. And we just think this is not going to escape notice for that much longer. Now, the other thing is, it's just very difficult when you haven't seen something with this kind of NPV. People don't know how to value it. It's almost, it's basically, an apples to orange comparison for a lot of investors. And then there are a few key misconceptions about the project. All right, the misperceptions. Some people say, oh, there's a river running through this. It is a stream. And by the way, yes, this is Canada, but if you go back to that point that I made, with 20 million tons of gold have been mined in the Yukon over the years, almost all of it having been placer mining, from streams have been diverted all the time. So we don't have concern that they're going to be able to divert this stream. People say it's too remote. Yes, but it is accessible. And then people say, well, given its remoteness, the grade, 1.2, on those 1.2 grams per ton on those 8 million ounces is too low. Well, that concern is an example of just how bad a lot of, air quotes, investors in the junior mining space are. All right, yes, it's remote, but if you look here, so everything in yellow, that's Snowline, except the kind of brownish one. That's Rogue. And again, that's why a major will buy it. But there's a light gray area there. That's Tungsten mine. That's a Lundin property. So that has received money from both the US and the Canadian governments recently because that's a critical mineral. So what does that mean? That means that Fireweed, that's the Lundin mine, they're going to be developing infrastructure in that area. Now, this does need about an 80-mile road to connect it to North Canal Road. And so we've plotted out what that road would look like. Importantly, you're going through low-lying areas. This does not take you, over mountains. This is imminently doable. The company will also have to reinforce North Canal Road. It's not, it's a mostly dirt road. It's not ready for mining operations yet. But when you have a 10 billion NPV project, which these numbers are already baked into that more than pays for itself. It shouldn't even really be a consideration. Now, here's the thing. When we're talking about how majors explore brownfields, this is what they call an elephant, a deposit this big. This will unlock the district. So majors will also love this because high probability that there are additional deposits there that they can explore later on and exploit. So there will be infrastructure built here. That infrastructure will be able to be likely shared over numerous projects. Now, when the 2025 mineral resource estimate came out, it caused a 7% drop on the day. So you see on the right, the grade that the overall ounces went up to about 8.8 million ounces. But the grade dropped from 1.45 to about 1.1. So people freaked out. But here's the thing. It's like people didn't read the bottom half of the press release. Like literally this is all on one page. The high grade core, that grew by almost 10%. All right, that's the high grade. The cutoff there is 0.6 grams per ton. So this is actually very bullish because again, you go back to that concept of you want to be able to start with the really high-grade mineral or the really high-grade ore that you're pulling out of the ground. All right, so the challenges here, as I said, from an investment perspective, there are no good comps. Canada is a first-world jurisdiction, which is great from the perspective of selling the mine to a major. You know, I mean, obviously in jurisdictions where you're concerned about expropriation, this would be a harder sell. It does have a long permitting timetable, though. That is true with Canada. But look, we think this project works at $1,800 gold. So again, just don't see much downside risk here to the price. So to summarize, we expect this to be acquired within 3 years. And if it's acquired in the next year, we think it's 4 to 6 billion CAD. But the longer it takes for this to be acquired, the higher the price will be. Thank you very much.